It's Sunday evening, January 18th, 2026. Most people are winding down their weekend, maybe meal prepping for Monday, scrolling through their phones. But in a corner of the financial world that never sleeps, the silver market is vibrating with an energy that feels almost electric. The ticker says $90.88. Mainstream financial media, if they're even covering this on a Sunday night, will tell you this is a speculative bubble, social media hype. Retail investors getting carried away again. They'll assure you that by Tuesday morning, sanity will return. Prices will mean revert, and we can all go back to ignoring silver like we have for the past 40 years. Here's what they won't tell you. That $90 figure on your screen is not the price of silver, it's the price of a promise. A digital IOU that an increasingly fragile system is struggling to honor. The real story isn't the number climbing on the chart. It's what's happening in the physical world, where the exit doors are being systematically welded shut. And the people doing the welding? It's not the banks. It's not the institutions, it's you, it's retail, it's stackers who've decided that paper claims aren't good enough anymore. I've spent over a decade in the commodities space, analyzing physical metals with institutional grade tools most retail investors never get to see. I moved to this format purely for speed because right now in this market, waiting 48 hours for traditional analysis to publish might as well be waiting 48 years. What I'm seeing in the data tonight isn't speculation, it's a structural shift that most people won't recognize until it's already happened. Let me be clear about what this video is. This is my thesis on why we've moved beyond meme squeezes and gamma ramps into something far more significant, structural accumulation. Retail investors are draining global vaults at the exact moment that China, the world's refining warehouse, has frozen exports. We are watching, in real time, what I'm calling the Great Divorce, the splitting apart of the paper price trading in New York and the physical reality you can hold in your hand. Tonight, I'm going to walk you through the mechanism behind what I call the backwardation trap. I'm going to run the math on why $90 is actually cheap when you compare it to the real cost of physical delivery. And I'm going to share my personal 3-step battle plan for navigating what comes next. This isn't financial advice. This is what I'm doing with my own capital, based on data I am seeing right now that won't hit Bloomberg's front page until tomorrow afternoon at the earliest. Let's start with where we are at this exact moment. I was looking at the screens a few hours ago, and here's the snapshot. Spot silver at $90.88, fighting to hold that psychological $90 line. The dollar index, the DXY, sitting at 99.2. The dollar is bleeding, and that's fuel on this fire. But here's where it gets interesting. March 2026. Futures are trading at $92.64. That's a $1.76 premium over spot. In a normal market, that spread should be maybe 30 to 50 cents tops. A 176 premium is a massive red flag. On your screen, silver is up. You can click a button and buy silver at $90. But in the real world, if you call SD Bullion or APMEX right now, they're quoting you 4-week delays. You can execute the trade at 90, but you can't touch the metal for 90. You're paying spot prices for delivery times that suggest the metal isn't actually there. Stop for a second and look at something else with me. The gold to silver ratio. Right now, it's at 50.8 to 1. Silver is screaming past gold. This isn't silver tracking gold's safe haven bid. This is silver leading. That's highly unusual, and it tells me something specific is happening in silver markets that has nothing to do with gold. But here's the question that should be bothering you. Why is the future price so much higher than the current price? That gap, that contango in reverse, what we call backwardation, that's where the trap is set. Let me explain what's actually happening here, because this is the mechanism that makes everything else make sense. Backwardation is when the spot price, the price for immediate delivery, exceeds the price for future delivery. In a healthy commodity market, futures should trade at a premium to spot because of carrying costs, storage, insurance, the time value of money. When that flips, when everyone wants it now more than they want it later, the market is telling you something critical. The cupboards are bare. Let's pull this apart with an analogy. Imagine you have a ticket for a loaf of bread at a bakery. Normally, that ticket is as good as the bread itself. You can redeem it anytime. The bakery has enough flour, enough ovens, enough staff. The ticket system works because supply and demand are balanced. But today, there are 100 people holding tickets and only one loaf in the oven. Suddenly, the ticket doesn't matter. The paper claim you're holding is worthless compared to actually standing next to the oven. The person physically closest to that loaf wins. Everyone else is holding promises. This is the Great Divorce I'm talking about. Most retail investors own tickets. They own ETFs, like SLV. They own futures contracts they never intend to take delivery on. They own digital claims on silver sitting in a vault somewhere that may or may not actually be there, may or may not be encumbered by multiple claims. If this great divorce completes, if the paper market fully decouples from the physical market, those tickets get settled in cash. You bought silver exposure at $30, silver's now at $90. But instead of getting your metal, you get a check for the difference based on some closing price that's already divorced from reality. Your investment gets devalued while the actual metal disappears into private vaults and never comes back to market. Think of it like this. You're holding a claim check for a coat at a restaurant. But while you were eating, someone walked into the coat room and stole every coat. When you try to leave, they hand you $20 and say sorry for the inconvenience. You're compensated, but you're going home in the cold. And here's the kicker. While you're standing there holding your paper ticket, the world's biggest supplier just walked out of the bakery entirely. Let's talk about the math, because the numbers tell a story that most people aren't connecting yet. According to Vanda Research data, retail investors poured $921 million into silver in just 30 days. That's not institutional money, that's retail. That's stackers. That's people buying physical coins and bars, smaller futures contracts, retail accessible ETFs. At current prices, that's roughly 10 million ounces absorbed by retail in a single month. The LBMA, the London Bullion Market Association, which effectively sets global prices, has around 1 billion ounces in vaults. A 1% monthly draw might not sound like much, but at this rate, we're talking about a sustained drain that the system was never designed to handle. Goldman Sachs just revised their silver volatility expectations. They're now modeling 7% weekly price swings as the new normal, up from 2%. When Goldman starts repricing volatility like that, it's not speculation. It's risk management based on what they're seeing in their order flow. Now let's stress test this. This morning, January 18th at 8:04 a.m. Eastern, reports surfaced that the administration is threatening 25% tariffs on European imports. Whether that actually happens or not, the threat alone drives safe haven demand. When trade wars heat up, physical assets become ports in a storm. If safe haven demand doubles from current levels, we're not talking about 10 million ounces a month anymore. We're talking about 20 million, maybe more. Here's the supply side of that equation. Global deficits for 2026 are estimated between 30 million and 200 million ounces, depending on whose model you trust. That's already a deficit before we account for the China variable. China represents 60 to 70% of global refined silver supply, not mine production. Refined supply, the stuff that's actually usable for manufacturing, for minting, for delivery against contracts. As of right now, China has frozen silver exports. They haven't said for how long. They haven't said under what conditions they'll resume. They've just closed the tap. You cannot solve a deficit of this magnitude by raising interest rates. You cannot solve it by jawboning retail investors to calm down. You cannot print silver the way you print dollars. This is a math problem with no policy solution. So when I look at spot silver at $90.88 and I compare it to the physical drain happening in real time, that paper price is mathematically impossible to sustain. The only question is how long the system can keep the fiction alive. Now, I know what the skeptics are saying. I can hear it already because I've had these conversations a dozen times in the past week. Substitution will save the market. Solar manufacturers will just switch to copper paste. Industrial demand will collapse and the price will crash back to $30. Let's Steelman this argument because it's not completely without merit. Substitution is real. It happens. When commodities get expensive enough, industries find alternatives. But here's what that argument misses. Substitution takes time. TOPCon solar cells, the current cutting-edge photovoltaic technology, are optimized for silver paste. Switching to copper paste isn't a firmware update. It requires retooling manufacturing lines, redesigning cells, testing new efficiency rates, getting new certifications. That's an 18 to 24-month process minimum. We're in January 2026. Even if every solar manufacturer started the substitution process today, they're not hitting production scale until late 2027 at the earliest. In the 18-month window of this crisis, there is no substitute. The other myth I keep seeing is this idea that higher prices automatically bring out more supply. Silver will flood the market once miners see $90 prices. Here's reality. Miners don't flip a switch. Opening a new mine takes years. Expanding production at existing mines takes quarters. You need permits, equipment, labor, infrastructure. By the time that supply hits the market, we're in late 2026 at best. What about recycling? Urban mining? Melting down old jewelry, electronics, industrial scrap? Yes, that will increase. But recycled silver doesn't hit the market instantly either. It needs collection networks, refining capacity, logistics. The recycling surge won't meaningfully impact supply until late this year, maybe Q4 2026. Right now, in Q1 2026, we are in a supply vacuum. And the institutions know it. They're not waiting for recycling to save them. They're already changing the rules. So what happens next? Let me walk you through the most likely institutional reactions and the specific indicators I'm watching. First, watch for the CME, the Chicago Mercantile Exchange, to hike margin requirements on silver futures. This is their go-to move when volatility spikes. They'll raise the amount of cash you need to hold a futures position, which forces smaller players to either post more collateral or liquidate. The narrative will be about market stability and reducing systemic risk. The reality is that it shakes out what they call weak hands. Retail traders who can't meet the new margin calls. It's a way to protect the bullion banks who are short these contracts and increasingly unable to deliver physical metal. When that happens, you'll see a sharp, violent sell-off. It'll look like the bubble popped. Financial media will declare the silver squeeze over. But pay attention to what happens in the physical market during that sell-off. If premiums don't collapse, if dealers don't suddenly have inventory again, that's your signal that the paper sell-off is just noise. Here's my personal dashboard of indicators I'm checking multiple times a day. LBMA vault levels. London holds the majority of globally accessible silver. If those stocks drop another 2% this month, the drain is terminal. We're past the point of no return. The physical market will have decisively decoupled from paper, the EFP spread. That's exchange for physical. It's what it costs to convert a futures contract into actual metal. Right now, it's elevated but not catastrophic. If that spread crosses $3, the paper market is broken. At that point, futures contracts are no longer effective price discovery mechanisms. They're just side bets disconnected from underlying reality. And the dollar index. I mentioned earlier it's at 99.2. If the DXY stays below 100, there's no ceiling for silver in dollar terms. A weak dollar is jet fuel for hard assets. We could see 100, 110, 125 without breaking a sweat if the dollar continues bleeding. One more thing to watch. Changes to delivery rules. If the COMEX or LBMA suddenly announce they're allowing cash settlement in lieu of physical delivery, even as an option, even as a temporary measure, that's the end game. That's the system admitting it can't deliver. And when that happens, every paper claim becomes instantly suspect. This is the moment where you have to decide. Are you holding tickets or metal? Let me tell you what I'm personally doing with my capital right now. Not advice, just transparency about my own positioning. I'm not looking at the $90 headline. That number is almost meaningless to me at this point. What I'm watching is the EFP spread and the technical levels from 2025. I have two triggers set in my mind. Trigger A. If silver dips back to $84, and that's a retest of the old highs from earlier breakouts, I'm personally looking to add to my physical holdings. Not paper, physical. Coins I can hold, bars in a safe I control. In a structurally deficit market, I view that dip as a gift. It's the market giving me one more chance to accumulate at a discount before reality catches up to price. Trigger B. If silver spikes to $110 based on rumors of CME cash settlement or some other institutional crisis, I'm sitting on my hands. I will not chase a vertical spike driven by panic. Those moves are violent, and they reverse just as fast. I've been in this market long enough to know that when emotion takes over, the smartest move is often doing nothing. As for silver mining equities, I'm holding what I have, but I'm not adding. The premiums are too high right now. Mining stocks have run hard on this move, and the risk of a margin hike flush, where the CME forces liquidation and everything connected to silver gets taken out, is too real. If we get that flush and mining stocks crater while physical premiums stay elevated, I'll reassess. But for now, I'm flat. Here's my conditional logic, and this is important. If the EFP spread blows out past $3, I stop looking at screen prices entirely. At that point, the only silver that exists is the silver you can touch. Paper claims are just numbers in a database that may or may not be honored. I'm not saying we're definitely going to that scenario, but I'm positioned for it because the math says it's possible, and the data I'm seeing suggests it's becoming more probable by the day. Let me pull this all together. $90 silver is the result of what I'm calling a perfect storm. You have China exiting as the world's refining hub. You have retail entering with conviction and size that's never been seen before in this market. And you have the death of the paper-to-physical bridge that's held this system together for decades. The paper price and the physical price are divorcing. That's not hyperbole. That's what backwardation means. That's what 4-week dealer delays mean. That's what a 176 contango premium means. This isn't about getting rich anymore. I know that's what brought a lot of people to silver. The idea of a short squeeze, a gamma ramp, a 10-bagger trade. And maybe some of that happens. I'm not ruling it out. But what we're really participating in is the greatest repricing of a hard asset in our lifetime. We're watching a market realize, in real time, that claims on silver are not the same as silver itself. That's a philosophical shift as much as a financial one. And when that shift completes, the world looks different on the other side. If you want to understand how we got here, you need to see the full picture of China's export ban and what it means structurally. I broke that down in my previous video. The history matters because it shows this isn't random. This has been building for months. The Greenland shock over the weekend was just the catalyst that made it visible. I'll link that video in the description and watch it. Connect the dots, then decide for yourself whether you're holding tickets or metal. Because the doors are closing, and unlike the movies, no one's going to hold them open for you.